Hello everybody. I was just about to make a video on China, and today's 4th of June 2018, and a little bit over 2 years ago I created another video that was had a headline that was a little bit more sensationalist. I suppose I was building up the subscriber base and wasn't really aware or didn't really know what I was doing. So this video was created on May 13th 2016, so today being 4th of June 2018, just over 2 years. Like I said, 45,000 views. Here's why China is screwed, and so is Aussie property and economy. 2 years later, granted, China is still chugging along. Australian property is still going up, or has gone up in those last 2 years, so nothing seems to have changed. This is the old video.
What about China? Because of course debt accumulation in China, we've had some reasonable inflation. What about China? Because of course debt accumulation in China, we've had some reasonable inflation figures, but that continues to be a major issue now.
Yeah, China is the biggest debt bubble we've seen. Now China has followed the route of many emerging economies, virtually all emerging economies, but it's done it to multiples of the size, and all of those previous emerging economies have come down the other side and had some kind of crash. Now the issue with China is that I have no doubt that they will crash at some point, but the issue is when does that crash happen and how much further they can puff up the economy to forestall that crash. What do you...
Alright, well, that was a little bit over 2 years ago. Like I said, nothing's changed. Nothing seems to change at all, ever, which is kind of a good thing. But then they say change is as good as a holiday, so take it whichever way you like. Alright, and this is now what they're talking about China. Alright, I'm not gonna spoil it for you, so watch this. This came out just 2 days ago.
The Reserve Bank has raised a red flag about Australia's biggest trading partner. Reserve Bank Governor Philip Lowe says the build-up of debt and bad loans in the country is a major risk to the Australian economy. Philip Lowe says the surging debt levels in the country poses the risk of a serious accident.
That experience is that the build-up of the financial risks like those we've seen in China is almost always followed by a marked slowdown in GDP growth or a financial crisis.
He's particularly concerned about the rise of shadow banking, which now accounts for nearly 50% of debt in the country. Tim Murray from J Capital has just returned from a trip to Beijing. His meetings with steel traders, bankers and analysts has further confirmed his view that we should be worried about China's ticking debt bomb. I spoke to Tim Murray earlier. Tim Murray, thank you for joining The Business. The Reserve Bank Governor outlining why he's concerned about the debt levels in China. Is he right?
Look, I think it's fantastic that he's worried about that and that he's got staff on the ground in China monitoring the situation. I think he's been conservative in his pronouncements about how bad the debt levels are. He said that debt levels are now 260% of GDP. Our research would say it's more like 328% of GDP.
So he should be actually much more worried than even this speech would indicate.
I think the idea of a financial crisis in China is unlikely. Now, that's not saying it's not a big problem. If you think about servicing this debt, it's now the servicing costs, the interest payments on the debt are running at 16% of GDP. With GDP growth at 6%, it's almost like a Ponzi scheme. You've got to keep lending in order to keep the economy rolling.
We've been
GDP. With GDP growth at 6%, it's almost like a Ponzi scheme. You've got to keep lending in order to keep the economy rolling.
We've been thinking of...
This is normally where I would stop the video and say something about the Ponzi scheme and the, you got to keep borrowing, but I'm sure there's going to be plenty of comments on that topic because that's the whole financial system, because if you have no credit, you have no money. So we are relying on endless borrowing until it all blows up, which is something we call a global financial crisis, or in this case, China may have a financial crisis. As they said, Philip Lowe said that it's almost always, this amount of debt is almost always followed by a financial crisis or some sort of other troubles. So what do we know?
Analysing whether or not China would have to go through a hard landing in order to sort these issues out. It seems to have just been kicked down the road continuously. When is the day of reckoning, do you think?
So I'm always impressed with the creativity the Chinese government brings to the approach of solving these problems. I think one of the current sort of ways of thinking about it is we're in a transition period where we're not going to be dealing with a lot of structural problems. We're going to be sorting out debt problems. And so there's a big focus on controlling debt. So you see companies like Anbang and Hainan Airlines being taken over in order to sort out their debt. There's a whole range of smaller companies like that. You can also see this sort of bifurcation of the country into good provinces and bad provinces. Bad provinces being told to stop building things, stop infrastructure in order to sort out their financial problems. So I don't see a crisis at any time soon.
But that's only because they're effectively shifting the debt around the country. Normally financial crises are brought on when somebody calls on their debt. They start to get worried about the ability of the person who owes them the money to pay it back, so they call upon it. Won't that happen in this case?
The ultimate power is all in the one place. The people borrowing the money are state-owned, the people lending the money are state-owned. That can be controlled. I mean, the things they can't control as much are household sector, but the level of debt in the household sector is not at enormous levels. It's around 45% of GDP or even lower. So it's not a big issue. I think that the real problem is in foreign reserves, and they're now only 10% of money supply and about 30% of household deposits. So if people decide they think there's a lot of risk in an RMB devaluation and start moving assets out of the country, which they did between 2014 and 2017, $1 trillion left the country. If that happens, then you then move into a maxi devaluation of the RMB. And at that point, any foreign banks that are lending to China may not get paid back, because the Chinese government might decide to default on a loan rather than reduce the foreign reserve holdings in our banking system.
I reckon if that happened, if China said to the foreign banks, we're not going to pay you back because we just don't have the money, or we'll pay you back in these devalued renminbis, I reckon that'll be the start of the Third World War. But obviously that won't be sold to the public as a financial Third World War. We're going to attack China because he hasn't paid us the money. It'll be some sort of other reason, like South China Sea islands and dispute and territorial dispute over some islands and some things that really are not the crux of the problem.
Let's run through what happens in an economic crisis. A big part of the speech of the Reserve Bank Governor was talking about how entwined Australia's economic fortunes are with what happens in China. We're so reliant upon them for almost all our markets now. What happens if they hit economic crisis to us here?
Really simple. They'll build less, so less iron ore will leave the country, less iron ore, less coal. Less tourists will come here, and less agricultural product will be sold there. If there's a large devaluation in the RMB, people won't be able to afford the education services. They'll choose domestic products over imported products for wine, milk, etc.
So that basically means almost every level of the Australian economy will receive a downturn, if not go into recession.
Just like we went up as China went up, we will go down if China goes down.
Tim Murray, thank you for joining the business.
Thanks for having me on, Carrington.
Well, there you go. If China goes down, we go down. Nothing we haven't heard before. Doom and gloom news. Sell paper. I didn't bring that to you because of it. I just wanted you to see where China is at 2 years after we've declared that China is screwed. So China is still being screwed, or screwing itself. But it's still standing strong. And now I'd like to focus your attention on something that this channel has talked about a lot, Australian property. This gentleman, Michael Heffernan, was interviewed on Friday as part of the market update, and then he was asked about the Australian property. Now, what I like about people like this man is that they work in the industry. They don't work for some. They're not academic, deeply involved in theory and no practice. People like this man, they work for private companies, investment companies. They are on the ground. They've got the pulse of the market in many different aspects, and not just theoretical. They can see who's buying, who's selling, where the money is going. So I kind of value their opinion a lot more than once again some professor from economical university with no real life practice and experience.
UBS also out with a report today suggesting further evidence that the property market has turned. They picked the top last year, and now suggesting with credit tightening occurring, we're going to see prices continue to fall. What's your opinion?
Well, I don't think you'd have to be Nostradamus to know that the housing situation was going to ease off a bit. I mean, you can't have share prices rising by 100% every 2 years forever. So that sort of thing had to come off the top, and I think it is now. I mean, you can't have share prices rising by 100% every 2 years forever. So that sort of thing had to come off the top, and I think it is now. I mean, simply put, a lot of people probably can't afford to pay the going price of houses at the moment. Whether it's tightening of credit or not, I'm not so sure. I think for good purchases, quality purchases, I think there's credit available for them, and indeed we've got the Royal Commission playing around with things. So I think we'll have to see how that all washes up before we can close the book on the housing sector. Indeed, if I just go on a little bit more here now, early in the late 80s and early 90s, we saw a huge increase in house prices, and for the next 7 years, it didn't collapse, but it stayed the same. And maybe that's what the future holds for the housing sector.
The Royal Commission turning focus to the relationship between banks and small business, it didn't generate the same level of headlines, I think it's fair to say, Michael. Do you think
All right, well, that's it. If we're going to use history to judge the current situation and future, this man tells us that maybe next 7 years, not that he's some sort of Nostradamus, but, again, we'd like to see the most recent history and somehow think that that'll happen. So next 7 years, the housing prices are not going to crash. They're going to stabilize just the way they did in the late 80s, early 90s, I think you just said. So with that, thank you very much for watching, and I'll talk to you in the next video.